Hello guys, welcome back to the FX Academy, and today we shall be backtesting our strategies. Today we shall be backtesting the use of fair value gaps and how we spot liquidity during a move. So this is a gold pair. You know, gold is one of the most tweaking pairs concerning liquidities. So basically, before we go even further with the forward information, let's first analyze the previous information. So analyzing the previous information, we see that the market was in an uptrend, creating a series of higher high and higher lows. So but basically we see that we had a change of character, and many thought that things were going to go their way. Like they thought the market would just make a simple pullback like here, and then they go short or they go into a sell position. But that wasn't the case. We see that many got stopped out from here, others got stopped out from here. So there are all reasons as to why they got stopped out. So the first reason is that here it was a fake change of character. Let me even name it. Let me put it in red to show that it's actually a fake one. Sorry, show that it's actually a fake one. So this was a change of character that was fake. Why was that this change of character fake? It was fake because here we had equal lows. Here we had equal lows, and most people think like be having equal lows, they should all be at the same level, or like this. So that's the only equal low they know. Like these lows should be at the same level. No, it could be actually be 2 to 3 candles that make the equal lows. That's how many get stopped out. So we clearly see that this was a fake change of character, and for us who traders, if you knew about this, then you would know that now liquidity has been swept. So you wait for moves. So the first move, we can say again, we see that we had a real change of character. Like after this fake out and liquidity being swept, we see that we had a real change of character. We had a real change of character. So here now the trend is has completely changed. It's now a total movement up. So what do we expect? When we look at this move again, we see another inducement. I call that inducement like a trap for traders to fall into long moves. This was an inducement, but it wasn't that a major inducement. However, we should always take keen of that such stuffs. So far we can now see how prices ran. Now on playing this out, we see that I know many traders, after them missing this move, they waited for a little pullback and then they went long. But rather than inducement here, you would have waited for this to be for such a move to be like stopped out, like liquidity had to be corrected against for a bigger move. So for anyone that went into this move had to be stopped out. Okay, let's see. Still people got stopped out here. So all this long week it was a stop out. People got stopped out completely. So as a trader, in the trading game, it's always a boring game because you need to be very, very patient. So you could always wait, seeing market moving, but you need to wait till the market tells you now it's your turn to be rewarded for being a waiting guy. So let's see what happened next. After liquidity was collected, we see it moved, but it was moving in a way such that there is no actually, in a way such that there was no big momentum. Like at least it would have moved in a way straight all the way up, but we see that it's a little bit lagging here, meaning that the liquidity collected here isn't that enough. So the market has to trap to make another trap for you guys to fall in. So basically, let's see how this moved. So as a trader whose experience is better, you wait till you get a better move. So basically, we see that price moved up good enough. We had a strong break up. Let me first remove this. We had a strong break up. Now, us having a strong break up, we can mark this as our original our first break of structure. Now the market is now starting to tell us that something is about to happen. So as a trader, you wait. With that, we even see that we are having an order block. We know very well an order block is where orders have been accumulating. So that's why you even see that after a trigger and the order block, we had a strong move up. Okay, a strong move up, causing a first break of structure. So this was our order block. Okay, that was our order block, and clearly we can see this how the market is moving. Immediately, not only the order block, now the market is giving us opportunities. We are having a fair value gap. Okay, we're having an imbalance left out. So as a pro trader, you would mark also that. You would mark that as our fair value gap. Now, our rule now is to wait patiently for the market to give us something good. Now, we see that we see that the market was moving, but it never mitigated our zone. Why? Is actually making traps again. Like we are having another trap here. Why? It shows that it has to come back to the zone. However much it never mitigated it. It's now faking levels for people to go in. Now these are market makers. We are having an inducement there. Yeah, we are having another inducement. Inducement is actually a trap for the liquidity, a trap to collect liquidity. Now, us having an inducement, now what else? They should actually set something like after them putting an inducement, bro, they came and put a tiny order block. Not only an order block, but then they also they put an order block there. These are all traps. Because why are these all traps? Because now you've seen an inducement here. You know very well that prices will always come back and strip that liquidity. So if you fail to analyze and see the liquidity, congratulations, man, you become the liquidity, get stopped out and be like, what happened, man? I did my analysis and I had to go long. Yes, the direction you predicted was correct, but you never saw the inducement, the liquidity trap. So basically, you know the liquidity. Immediately, we can see that they actually formed another fair value gap. Now, and actually, not only that, we had another small break over structure here. Like that's all. These are all traps. Why do I say that they are traps? If we see this as our swing, like, okay, a moment, let's first spread this out. We see that price is moving up. Okay, now if we see this as our swing, we and we apply our Fibonacci level, like from here to here, okay, we see that prices never even came to a discount zone. Like, they never came to our discount zone. What does that mean? That means that this all one swing still moving. It's not a change of character, like it's not a break of structure. So this was a fake break over structure. Now, anyone that put orders, like they put orders in the middle of the fair value gap, and maybe they put the orders in the middle of the fair value gap, put stop losses below the zones, and maybe target the recent high, they all got stopped out. Why? Because we know that inducement has to be, like, liquidity has to be swept for this move to go up. Remember that liquidity is a fuel of the market. So let's see what happened. We see that now their orders got triggered, okay? But remember, for us, we want to go long from here. We want to go long from actually here. Like, I would put my stop loss towards the order block. Why? Because this is very confluential. The fair value gap is big in size. Not only that, we had a clean break of structure. Not only that, we had a strong move. So basically, we can see that all these guys had to be swept out. Now, not only that, we see that this was a fake move. Okay, see that this was a fake move. We see that this was a fake move. So, and the inducement or liquidity had to be swept. Let's see that immediately their liquidity was swept, meaning that even those traders got stopped out of the market. Now, as a trader, what would you do? I told you guys you should be patient with the market and then wait for prices to come to our zone. Now, these were all fake outs. These were all traps. So the original move was after sweeping this liquidity or the inducement trap. So for us, we would put our orders, as I told you, in the middle of the gap or the fair value gap or the imbalance. Put our stop losses slightly below the order block, or me always put in the middle between the fair value gap and the order block. Depends on your risk management context. Now, I target the previous liquidity. So this was a previous liquidity, and we know very well always prices move to sweep liquidity. So from there, let's see how prices would have acted, or according to the analysis. Now we see that our analysis moved smoothly. Like, after you waiting, all the waiting, the move is always good. Like, never pressurizes you. It moves in a smooth direction. Now, we never had a drawdown of any other rows. So basically, that's how we use fair value gaps, how we use order blocks, and how we identify inducements or liquidity traps. So thank you for watching. We meet in another episode.